I have mentioned a few times that obviously we need to know when to buy and when to sell, how to create a good trading strategy, and this is going to be the main focus point of this part now. So we're going to learn about chart reading, price action, trading strategies. So when we take a look at a Forex chart or any chart for that matter, we have different ways to visualize it. Sometimes you will see something like this here on the left-hand side. This is what you'll usually probably know from TV or from other financial medias. This is what we call the line graph. And we have also a candlestick graph, which is what we are going to use here for this video. And the differences between line graph and candlesticks are obviously that the line graph has much more compressed information. It only shows you the closing prices, and it is ideal for getting a general overview of where the market is going, where it came from. But we as traders, we need the candlesticks because candlesticks show us more information. Instead of only having the closing price, we have the open, the close, the high, and the low. And we use the candlesticks to make detailed analyses and to time our trades. What is it actually that we're looking at when we're looking at such a line graph or a candlestick graph? And for that, in trading, we are using time frames to visualize the data points differently. So time frames break down our line graphs and the data points into different segments and periods. So for example, on a line graph, each closing price represents a new timestamp, and this could be either days, it could be minutes, it could be hours, it can even be seconds. And we need to understand how to choose the right time frame for our investment horizon. When we look at a candlestick graph, we can see that each candlestick, each of those bars represents one time unit. And the time units, we can change that between hours, minutes, days, weeks, or even months. And when we look at time frames in trading, we are usually distinguishing between higher time frames and lower time frames. Higher time frames are generally considered the weekly, the daily, and the 4-hour time frame. With a candlestick graph, this means that one candlestick is either 1 week, 1 day, or 4 hours. And then we have our lower time frames where one candlestick is anywhere between 1 hour and 1 minute. And this will then help us to make trading decisions on the specific horizon that we are interested in trading. So how do we use time frames? And very often you will hear things like a multi-time frame analysis. And this is where you are combining higher time frames and lower time frames. And generally what we are doing, we are using the higher time frame first to just get an idea of the general market. Is the market generally moving up or down over the past few months or weeks or days? What has happened recently? And then we can go to the lower time frame once we have established the higher time frame idea and general direction, and we go to the lower time frame. And on the lower time frame, you generally execute your trades. You can really pinpoint your entry into the right moment when you're ready to take a trade based on the higher time frame analysis. I will show you that in a bit. And when we look at a candlestick, let's just go over the very basics. I made a separate video here on YouTube where I go into the actual price action information detailed step by step, and the video is about 1 hour. So if you want to get more, make sure to also check the link in the video description about my free YouTube price action course. But generally what we are having when we look at a candlestick is, as I said, we have the open, the low, the high, and the close. So we have 4 data points per candlestick. And one candlestick, as I said, can be 1 hour, it can be 1 minute, it can be 1 day, depending on the time frame that you choose. And when we have multiple candlesticks, we can connect them together. And the line graph, as I said, only shows you the closing prices. So on a line graph, you have only a very compressed information data set, only closing prices. But on a candle graph, you can see much more information at the same time. So generally in trading, we need to use candlesticks because we need a little bit more information than just the closing prices. And when we look at candlesticks, we can usually distinguish between very bullish and very bearish. Bullish in trading refers to a market that is going up, and bearish generally refers to a market that is going down. So if the price is going down, we are talking about a bear market, as I will show you, and the price is going up, we are talking about a bullish market. And the same is true for candlesticks. We have bullish candlesticks where the price is moving up within the duration of the candlestick, and we have bearish candlesticks where the price is moving down within the duration of the candlestick. And candlesticks can be quite important and are very important in trading. But when you start looking at a chart, usually we want to start looking at a broader picture to get a general sense of where the market is coming from. And then we can use that information to make predictions about what is likely to happen in the future. And when you look at a Forex price chart or any price chart, we can usually see three things. The prices can go up, they can go sideways, or they can go down. And those are the three types of market phases that you will see. This is the only thing that can happen on a chart. Obviously, there are varying degrees. Sometimes the market can go up quicker, sometimes the market can go down slower, sometimes ranges and sideways markets take different shapes or forms. But when we look at a Forex chart, we are trying to distinguish between one of those three different phases, and that's very important. And as I said, the trend structure can change. Sometimes the price can go up fast. So in a short amount, the price moves quite a bit. Then the trend can also slow down. So in the longer period, the market moves only a little bit higher, and trends can also pause. And when trends pause, then very often trends can also roll into the opposite side. So when a market goes from up to downtrend, there are often great trading opportunities that we can find and that we can trade. And those are usually building the foundation of the so-called trading strategies that I was referring to previously. So to help you a little bit with your Forex jargon, we are now adding new concepts, and the first one is called momentum. And momentum refers to the speed of price. And as I said before, trends can move with varying degrees of speed, and how quick and how slow a trend is developing is very, very important. So when a trend is moving very fast and very steep, we're talking about a high momentum market. And you can see sometimes then trends are slowing down. And this is a very important development regarding momentum. So the speed of price is very important. So now comes a very important and very fun part, because now we're going to start digging into charts, and I will give you 6 tips on how to better read charts, understand charts, so that you can understand what is likely to happen in the future. See, I said likely, not predict, because as traders, we will never be able to 100% predict the future. And as I've shown you in the previous example with the 40% win rate, that is not even necessary. So we don't need to be right 100% of the time. And as traders, we only know what has already happened in the past. This is the only information that we have. But we can use that information to make assumptions about what is likely to happen in the future. And that is what we are now going to take a look at. So when we look at a price action chart, for the most part, it may look random, and that is true. For the most part, prices are pretty random, but our goal as a trader using a trading strategy is to find areas and trading opportunities that are not as random. And we can use different tools for that. For example, we can use so-called support and resistance areas, because when we look at a price chart, we will be able to see that there are price levels that the market is paying attention to very regularly. For example, here we have a level that is used many times by the price, and the price is continuing to show reactions at the price level. This is interestingly the 120 round number. Here we have the 117 round number. So you can see there are specific price levels and areas and concepts that we can use to make our charts appear less random, and this we can then use in our trading to find trading opportunities. So the first tip is only trade at key levels. And here is another example. We have a chart where we have continuously seen reactions at those blue zones, and we need to have them our charts and extend them into the future, because we are then going to use them in the future as well. So only trade at key levels and become very good at spotting support and resistance. And not always do those horizontal levels appear. Sometimes a chart seems to not follow any of those patterns, but we have a different tool in trading, and we can use so-called trend lines. And a trend line is trying to make sense of a trend. So with a trend line, we connect a trending phase. So in this example, you can see the market was going down here, and then we connect the highs in a so-called downtrend. And then we have a trend line. And how do you use a trend line? There are two ways how to use a trend line. First of all, you're looking for the moment when the trend is broken, when the trend line is actively broken. So here you can see the market was in a downtrend. We have a nice trend line. Here is then when the trend line was broken, and shortly afterwards the market really moved higher. So if you want to look for a way to buy a specific Forex pair, you wait for the market to break such a trend line. Here we have the opposite. The market was going higher. We have a very nice trend line that we can get by connecting the lows. And once this trend line is broken, this may be a good opportunity to sell. And a great thing is that you can then maybe add even the concept of support and resistance. Only look for trend lines and trend line breaks when there's also a key level. So support and resistance, trend lines, they often focus a little bit more on the broader picture. We're looking at complete trends or very, very long time frames of a chart. But it's also important to look at the price microstructure and look at the candlesticks. And one of the most favorite concepts of candlestick analysis that I use is a concept that I call deceleration. And when a trend is slowing down, this is often a very, very important piece to the puzzle, and a very important piece that can help us find trading opportunities. So here we are in a strong uptrend, and if we zoom out, you can see this is where this deceleration is happening. It is happening at a previous support area or resistance area. And when you see that the trend is slowing down into an interesting resistance area, that is then where you want to look for trading opportunities. You may, for example, go to a lower time frame and then time your trades there. But if you can spot slowing down phases of trends at key areas, that's a great way to enhance your trading strategies. Here, for example, we also have a previous support area, which is turning into resistance, and we can see that the previous uptrend is slowing down. So a great deceleration concept here. So number 3, wait for deceleration. Don't just trade randomly, but wait until you can see that a trend is slowing down, and then try to find trading opportunities into the new trend direction. Those can be great trading opportunities. I just said that it can be profitable and can be very good to find new trends, but how do you find new trends? And one of those great concepts that we can use are transitions or patterns. And patterns are, if you look at a trading book or any trading video or trading website, patterns are often coming up. And in my trading, I use patterns a lot because they are great for building a trading strategy around them. So a pattern connects trending phases. So here we have a pattern connector that connects a downtrend with an uptrend. So if we can spot a pattern, we can often use that information to then time our trades. Here we have a pattern connector within a long-term downtrend. The pattern is here in this case showing us a temporary pause. And once the market leaves such a pattern, that is where you are often finding great opportunities, because once the price is leaving a pattern, that's often where you see the fastest price moves. So a pattern can either be defined by a horizontal level. So if you see that the market is changing from a trend to a sideways market, and you are able to define the sideways market with a horizontal level, that's a great starting point. Or sometimes you can also use trend lines, diagonal lines, to define a pattern. So in this example, we are looking at a downtrend, and we can define the sideways period with a trend line. So wait for patterns is the tip number 4, because patterns are often the starting point for high momentum moves. And how do you trade those? That's the next question that you probably have now. All right, so how do you actually trade a pattern? And the rule for pattern trading is pretty simple. And in trading, we are referring to this with breakouts. So many trading strategies are considered a breakout trading strategy. And what are you doing is that you're looking for a trend. You wait for the trend to slow down. You wait for the trend to slow down within a pattern that you can really nicely map out. and then you are waiting for the price to break out of the pattern. And that is where a lot of traders are looking for trading opportunities. So tip number 5, always wait for the price to exit a pattern. The big problem that many amateur traders have is that they are too impatient, and as soon as they see a pattern, they will jump on it, and then very often they will just lose a lot of money because prices often stay within patterns for quite a long time. And even though you see those fake breakouts sometimes, so you really want to make sure that your price is actually completely breaking out of such a pattern. But there's a second way to trade a pattern, and the second way we are referring to that with a pullback, or some traders call it a retest. So after the market is breaking out of your pattern, there is your trading opportunity 1, and very often you see this pattern and you can see that the market is coming back to the previous breakout level. So where you have previously drawn the line for your pattern, you will often see the so-called retest. And here you can also see that we have a very nice horizontal level. The market is breaking out of it, and maybe you missed it for whatever reason. You missed this trading opportunity. Then the price is coming back and it's giving you a second opportunity here to trade that. And a bonus tip, now we are still looking at the same chart. We are here on the 1 hour time frame. Now we are on the 30-minute time frame, and we can zoom in on that on the lower time frame. And now suddenly this retest or pullback on the higher time frame is starting to look like a breakout on the lower time frame. So again, now we are able to define this pullback with a pattern, and we can approach it in the same way to wait for a breakout out of that. So you can really nicely see how we can go from broader picture to lower picture, and then really use the different time frames in a great combination together. So building a trading strategy part 1, this is very important obviously, because as I said, the trading strategy really provides you the framework, and a trading strategy is going to give you the rules that are really guiding all of your decision making: when to buy, when to sell, where do you place your stop loss, where do you take your exit, and many other things. And the goal of your trading strategy is that they will help you make consistent decisions. And the benefit of that consistent decisions lead to consistent results. And one of the big problems that a lot of amateur, new or struggling traders have is that their results are all over the place because they don't have a trading system, they don't have rules, they randomly jump in and out of the market, they don't really know what they're doing, and this is then leading to a lot of inconsistent results. And if you have inconsistent results, it is very hard to become better because there's a lot of noise, what we call in trading. And if you can reduce the noise, if your trades are very similar, if the trades are all based on the same rules, you will be able to look back at your trades and you will be able to ask yourself, okay, what is actually working well? What isn't working so well? And then you can make sure that you take more of the trades that work well, less of the trades that don't work well. And it's much easier to find that out if you have a consistent framework for your trading. So when you are developing a trading strategy, here are a few tips and pointers that you can use and questions that you need to ask yourself when you build a trading strategy. First of all, what are the time frames that you're using? You're using a multi-time frame approach or just a single time frame? And what is the time frame combination that you use? Number 2, how do you get into a trade? What are the entry rules that you're using? You're using a breakout approach, you're using a pullback approach. What are the rules and the tools that you're using? And how do you set your stop loss? What is the average rule for your stop loss placement? And also, where do you get out? What is your take profit placement? And when do you exit a trade, maybe even before that? Number 6, what is your position size? How big of a position size is it that you're willing to take? What is the risk that you're adding to your trading account? And how do you deal with news? As we've seen, there are always news coming out, and you need to have a plan how you're going to react and how you're going to approach news releases, especially if you are looking at high impact news releases, because they can move the market quite a bit. And do you hold trades over the weekend or not? Because sometimes something can happen over the weekend, some geopolitical situation emerges, and this can move the price a lot on your Forex pair. So you need to also have a plan ready for holding trades over the weekend. And those give you a good idea of where to start looking for a trading strategy and what are the questions that you need to answer. And to get more into the nitty-gritty, I also prepared the most common Forex questions for you. So let's do that as well to really round off what we are doing here. But first of all, I want to really point your attention to our trading education, because obviously now you have the foundation down, you know what a trading strategy is, but where do you actually get a trading strategy from? And I've been trading Forex for around 14 years, and I have compiled my own trading strategies with all the rules into an online video course. So if you want to learn my rules, and I will show you trade examples, chart reading, and I've covered all the different rules that a trading strategy has, then make sure to check the link in the video description. I've put 4 trading courses together, bundled them up, and you will get them for the price of 1 trading course. So there's everything that you need to know. There's even a more advanced Forex starter course. There's a multi-time frame trend strategy, supply and demand sequence, and many chart studies and trader studies. And this is if you want to learn on your own. If you are interested in having me as your trading mentor, we also have a premium Forex mentoring group where you also get access to all the courses that I have. Plus, you are able to join our live chat room where you can interact with me during the day. And I also hold up to 3 to 5 live webinars every single week where we go over the live Forex markets. I explain how I'm reading a specific Forex pair, where I want to trade it, what am I seeing, how do I get into a trade, and all of those things as well. So make sure to check all the links in the description below. So a question that I always get from Forex traders is about demo or live trading. What should you do, how long to do it, and what are the general tips? So if you don't know what those terms mean, demo means that you're opening a broker account, but you're not actually putting in real money. You're putting in demo money or fake money. And this allows you to interact with the Forex market just as you would with your real account. So the price moves, the Forex pairs, everything is exactly the same as it would be in a live trading environment where you put in real money. But if you enter a trade, you are not actually risking your own money. You are just risking play money. And the role of demo is that you are familiarizing yourself with the ins and outs of the Forex market. Very important is that you familiarize yourself with the broker platform. What actually happens when you press buy? What happens when you press sell? What is the development of spread? You can very nicely see that. You can also very nicely practice how to correctly size a position. So what is the difference between one lot, one micro lot, one mini lot? And you will be able to see that very nicely in a demo account. And I would recommend to stay on demo for a few months until you really know what you're actually doing. Replicating demo results to a live account is not going to be as easy. So I don't really think there's value in trying to validate a trading strategy on a demo account, because demo trading and live trading are very different when it comes to the emotional requirements. Pretty much everything that is considered difficult in trading, which is basically managing your emotions, risk management, and development over time, are not really a challenge or present even in a demo account. So once you are familiarizing yourself with demo, I would recommend then opening maybe a small live trading account so that you can really get a feeling for what it is and what is happening when you trade live money. But obviously then also different risks come with that, so make sure that you understand the risks as well. Will trading go away? Very common question that I get, and many traders fear that they are wasting their time getting into trading because they fear that maybe trading won't be around. And obviously nobody knows the answer, but what we can know is that trading has been around for many decades, probably in some way or form for hundreds of years. So my personal opinion is that trading will not go away. Trading may change over time, which is not necessarily a bad thing, which may be even a good thing, because what happens is that if you are familiar with trading right now and then trading evolves and takes a different form, you are going to be one of the pioneers in the new area of trading. So it's definitely worth getting into trading. Is trading gambling? Many traders ask that, and I would say if you look at the general definition of gambling, then definitely trading fits into that, because you are betting your money, the outcome is uncertain, and those are the definitions of gambling. However, there's a big difference between reckless gambling and professional gambling. And professional gambling means that you're trying to design a trading system that has a positive expectancy over the long run. So as I've shown you, we are looking at this reward to risk ratio in combination with the win rate. We are trying to create a trading system that helps us to have a repeatable structure in our trading approach so that we can take the same trades over and over again and then slowly build our trading system in a way that is giving us a positive return over the long term. But of course, if you want to look at the general definition of trading, yes, it may fit gambling, but is it really important? Does it really matter? I don't think so. Can you start trading with only 100 US dollar? Theoretically, yes, you could. Is it recommended? I wouldn't say so. Does it make sense? I don't think so, because how much money can you really make with 100 US dollar? In trading, we generally consider a good risk management practice that you risk 1 or 2% of your trading capital per trade. And on a 100 US dollar account, this means you're risking between 1 US dollar and 2 US dollar. And how serious can you really take trading if you're only risking 1 or 2 US dollar? Probably not very serious. And then obviously this introduces a lot of problems that come with that, where you just adopt very sloppy trading behavior. It may be okay in the beginning where you're just getting a feel for it, when you're just starting out and you want to understand how does everything work together. But long term, I don't think it makes a lot of sense. Do I have to trade a lot to make money? And many traders have the misconception that they always need to have a trade on and they always need to be in the market. They're always buying and selling all the time, and that is how you make money. But this is not necessary, and it is very important that you understand, if you want to build a long-term profitable trading career, you're going to do this for 10, 20, 30 years. And you're going to take many trades over the long term, but it doesn't matter short term. So you don't have to trade a lot. You don't have to trade all the time. It is very, very important that you focus on quality trading instead of quantity trading. And this is where we are trying to push our students towards quality trading, not quantity trading. It makes your life much easier. It takes away a lot of headaches, and it makes trading also a lot more fun and reliable. What is the best time frame? We talked about time frames all the way from the weekly down to the 1 minute. And then inevitably the question comes up, so what is the best time frame for me? And what is the best time frame in general? And the answer is dependent on the trader, on the personal situation. First of all, how much time do you have? Is it even feasible for you to trade the 1 hour time frame, or do you have a busy day job and you need to approach your trading a little bit differently? And this is very important that you answer this question for yourself. Again, if you enroll in our premium mentoring or in our courses, we're going to help you find the right answer for you. But basically, you have to estimate your own personal situation. If you have a 9-to-5 job, usually the traders are tending towards the higher time frames, so 4-hour daily, because you don't need to actively monitor the charts during the day. And if you have more time during the day, great, maybe you are then able to trade the lower time frames. You can have an active trading session where you block out 2 to 3 hours per day, maybe around the London Open, maybe around the New York Open, and you can trade that session for maybe an hour or 2 as well. What are the best trading books? And there have been so many trading books. I have actually compiled a list of the best and my most favorite trading books. And I will also put a link to that in the description below. So if you want to learn more about trading, there's a huge list with a lot of resources. What is the best trading strategy? And again, there's no one size fits all in trading. It always depends on the personal situation. And in trading, we generally consider between 2 categories of trading strategies. One is referred to as swing trading, and the other one is referred to as day trading. Swing trading approaches trading more from this long-term approach. So you're holding your trades maybe for a day, maybe 2, maybe 3, maybe 4. And day trading is where you have multiple trades in a day. And again, there's no right or wrong. Both trading approaches can be traded profitably. It really depends on the personal situation. And in our mentoring, for example, we give our traders both approaches. So we give them a swing trading approach and a day trading approach. We guide them on how to use both of them, and then we help them to make the right trading decision for themselves. What is the right approach for your personal situation? Where do you see your strength? Where do you see your weakness? And then you can find over time what is right for you. But in general, you cannot really say there's one better than the other. It always really depends on your situation. And I would recommend in the beginning, just try it out, see how a day trading strategy feels, see how a swing trading strategy feels, and then you can make the right call for your personal situation. And if you still have a question that I haven't answered in this video, leave a comment below. I will use those questions for my next video as well. So if there's anything unanswered, then make sure to leave that in the comments and I will make sure to address that in my next video. So I hope you enjoyed this very long video, very in-depth Forex tutorial. If you did, leave a thumbs up, make sure to subscribe and make sure to check back next Tuesday for the next video.